Good morning, good evening, wherever you may be, whether you're across the nation or around the world. My name is Shane Squarek, and on behalf of the CMT Association, I am pleased to welcome you back to another great webcast as part of our educational web series. Today, on March 15th, 2023, I'm pleased to welcome Manuel Blay to present Why the Dow Theory, Multi-Market Application, Outperformance, Drawdown Reduction, and a 120-plus year record. As always, we welcome you to submit your questions throughout the duration of today's presentation using the chat box to the right-hand side of your screen. In the interest of time, however, we may not be able to acknowledge all of your questions until the end of the formal presentation. Your participation in today's live webcast does qualify you for 2 CMT Association continuing education credits, which would be automatically added to your account if you registered online through the association website. That said, I am pleased to turn the floor over live to Manuel.
Hey, hello. Thanks for inviting me here. And to all listeners, I hope you will bear with my Spanish accent. I'm not an English native speaker. I will try to do my best. I hope you will understand everything. So let's get started. So the title of the presentation, Why the Dow Theory? There are many trend-following systems out there, moving average, rate of change, breakout systems. So why the Dow Theory? What makes it special? Well, I'd say first because it can have multi-market application, as we will see. There is marked outperformance and drawdown reduction versus buy and hold. And especially there is a 120 years plus years record. So this is not a couple of cherry-picked charts, no. And furthermore, this record has been proven by many practitioners. So it's not a thing that we made up. So it's really a proven record by independent parties. So this is why the Dow Theory. There is a short disclaimer. If you download the slides, you can read it in peace afterwards, but basically, well, it's your investment and it's your risk, and you will read it in peace later. Okay, so who we are. All this was started by Jack Shanep on the left. You can see him here. He was a broker with Dean Witter, and well, he started a really long time ago. And he's the author of the best-selling book, The Dow Theory for the 21st Century. In my opinion, this is one of the best books on timing the stock market ever written. I have to tell you, I derive no royalties. I'm not affiliated with the book. But if you want to do yourself a favor, I would buy the book and read it 3, 4, or 5 times. It's really an incredible book on trend following, specifically for the stock market. It is geared towards the long-term investor. Our trades last on average 1 year. And it really changed the way I saw the stock market. So for me, there was a before and an after reading this book. And now Jack Shanep continues as the editor emeritus of our website, and I am now the present editor. Okay, so you will be asking, okay, so what's the Dow Theory? Okay, it is one of the most accurate trend following methods. So this is technical analysis. It belongs to the family of technical analysis. It is not fundamental analysis. Within the family of technical analysis, it is trend following. And I would say it is quite similar to breakout systems, but it's similar, but it is not the same. It is much better, and by better I mean higher outperformance and drawdown reduction than the standard trend following breakout system. We will see later why. Okay, it was originally applied to the US stock market, but it can be applied to other markets. We will see that later. It is a long-term approach. The average trade lasts about 1 year, so it has nothing to do with day trading. So for me, it was great. It was really a perfect fit because I can target outperformance, drawdown reduction, but it's not so stressful that I have to be glued to the screen day in, day out. So of course, I check the markets every day, but it's really not so stressful to trade. And an important thing about any trading system is that it must be tradable in real life. You can backtest a trading system and say, oh, it would have worked great, but in real life, if it's too demanding on your time, it may end up being really not usable in real life. So the average trade lasts about 1 year, which makes it really something that can be really used in real life. And as I said, it has a 120-year plus successful and documented record. So we are not talking of cherry-picked charts and say, look, he was a buy signal, we make money. No. I would say it's almost like quantitative analysis, like quants, because okay, there are charts, but everything are figures. We have all the performance figures, drawdown figures, so it's really very well documented. Okay, let's go further. So the question: does the Dow theory work? Yes, because there is outperformance versus buy and hold. There is a marked notable drawdown reduction versus buy and hold. I would say the rule of thumb for the Dow theory is that it cuts drawdowns by half versus buy and hold. You can apply it to many markets, and some markets it could be a little bit more than 50%, some markets a little bit less drawdown reduction than 50%, but I would say it's a constant, like the speed of light or like the absolute zero is like a constant of physics. More or less, you cut drawdown by half versus buy and hold. And it can be successfully applied to many markets. Okay, now you will be asking, okay, now I know what's the Dow theory, but you want to know why the Dow theory works. I think it works and works better than most trend following systems because of 4 things. First of all, only relevant pivots matter. So let's take, for instance, the relative close relative of the Dow theory. Let's take a breakout system. You may be buying when there is a 20 days high. You may be selling when there is a 20 days low or a 40 days high, 40 days low, whatever. But if you're trading a breakout system, you are not pinpointing the specific pivots that really matter on a chart. So a 20 days high or a 20 days low may be a totally unimportant point on the chart. You will say, yes, but if you take out a 20 days high, it means that something is moving on. Yes, that's right. And this is why trend following works. But we can do better. So if you were able to single out only important pivots, not any end days high or end days low, you will have a more accurate, robust, and accurate trading system. Second, there are the time and extent requirements, which relates to the pivot question. The Dow theory is built around the concept of secondary reaction. So you have the uptrend, then comes the pullback, and this is the secondary reaction. But of course, how do you define what is a meaningful pullback, a meaningful secondary reaction, and what is merely a minor decline with no technical relevance whatsoever? So to separate an important declines or rallies from the really important ones, you need the time and extent requirement for a secondary reaction. So under the Dow theory, you need a minimum time for a pullback or for a rally. So for instance, if you have the top on January 1st, you need at least 3 weeks, according to the classical Dow theory, of declining prices to meet the time requirement for a secondary reaction. So if the pullback, the decline, lasted only 1 week, it will not qualify as a secondary reaction. In addition to the time requirement, we demand the extent requirement. So maybe you have 4 weeks decline, which would meet the time requirement, but the drawdown, the decline only reach -2%. In such a case, you don't meet the extent requirement. The Dow theory requires, at the very least, there is a minimum movement equal or greater to 3%. So now let's go to the third differentiating feature of the Dow theory, the principle of confirmation. The Dow theory says that highs or lows, that taking out a high or low, important pivots, but that are not confirmed by the other index, are worth nothing, so are to be disregarded. So let's imagine we have the Dow Industrials, and the Dow Industrials breaks up above a pivot high, and they say, oh, great, this is a buy signal, but the Dow Transportation has not confirmed and remains below its vital pivot point. So lack of confirmation means that no buy signal has been signaled. And you can test the principle of confirmation works not only with the Dow theory, it works with any trend following system. I've performed many tests, and you can do it. It's very easy to code, to program. You can code, for instance, a moving average system. And if you take only signals when just one moving average is given a signal and you demand confirmation, you will see a big difference when you require confirmation. Your profit factor will go up, your performance will go up, and most likely drawdowns will be further reduced. So the principle of confirmation works with all trend following systems. It's not a feature of the Dow theory, but of course, maybe the first trading system that stressed the importance of the principle of confirmation was the Dow theory. And this is a principle that is neglected, even for people that are using other trend following systems. Even if you continue using your moving average, breakout systems, rate of change systems, try to integrate the principle of confirmation, and you will see there is a difference. And lastly, finally, the fourth differentiating feature of the Dow theory is that it has a non-parametric nature. What do I mean by that? For instance, if you are trading a breakout system, your rules will be buy at 20 days high or 40 days high, sell at 20 days low. So this is a parameter. You are playing with parameters. So the Dow theory, it has a non-parametric nature, which gives it more robustness. It makes a more robust system. Because, for instance, you can have a breakout system and it works great with 40 days, but maybe it does not work so well with 20 days. So it is parameter dependent. The Dow theory, by having the secondary reaction concept and by pinpointing only the relevant pivots, does not depend on parameters. This really makes a huge difference when it comes to robustness. Okay, how does it work? How does the Dow theory work? Let's look at a typical buy signal. The blue line shows the Dow Industrials, the green line shows the transports. So if we look on the left side of the chart here, we see a downward trend. The trend is going down. Then we have under number one the lows. You see the transports makes lows, the industrials here. So we have the lows. And then follows the concept of secondary reaction. There is a bounce, and this bounce must last under the classical Dow theory 3 confirmed, once again the principle of confirmation, 3 confirmed weeks, and at least it must be 3 or more % on both indexes. So we have the bounce, number 2, here is the bounce, and then following such a bounce, there is a pullback. But this pullback is a pullback to higher lows. So the lows shown here on number 1 are higher. The new lows are higher than the lows shown on number 1. So there is a pullback equal or larger to 3% to higher lows. And this is what sets up the stock indexes for a potential buy signal. So what happens after those higher lows is vital. If we get a higher bounce, so we get a new rally, a new bounce, and this new bounce breaks up above our secondary reaction highs, the bounce shown on number 2, then we get a buy signal. Once again, the principle of confirmation is in action. We need both indexes to confirm. We need the two indexes, industrials and the transportation, to break up above the bounce shown under number 2 levels. What happens if only one of them breaks up? Nothing has changed. So there is no buy signal. Okay, let's move on. Now we will see the sell signal, which is the opposite side of the coin. Okay, how does it work? Sell signals. Once again, now we can see we have an upward trend. You see the blue and green lines going up. So we get the highs shown with number 1. Then there is a pullback, you see, which would be the secondary reaction on both the S&P, the Dow Industrials and the transportation, and then the secondary reaction. And then what follows is a bounce to lower highs. You see there is a rally, a bounce, but you see that the bounce ends below the highs shown under number 1. You see there is the highs, the pullback, there is a bounce, but to lower highs, and then there is a confirm, once again confirmation, breakdown to lower lows, lows below the pullback lows. So this would be the sell signal. Once again, we require confirmation. So if only, for instance, the Dow Industrials would break below the pullback lows, we would not have a secondary a sell signal. Okay. So, okay, how well does the Dow Theory perform versus buy and hold? Okay, this chart shows I took the Dow Jones Industrials total return from 1953 to 2022. So the Dow Theory had an end equity of $50 million. The start capital is $10,000. We start with $10,000. So we finished with $15,000. And buy and hold finished with $10.9 million. So there is outperformance. And furthermore, if you pay close attention to the charts, you will see that the Dow Theory has much lower, much muted drawdowns. You can see here bad years drawdowns 2008, and you can compare to the Dow Theory 2000, 2001, the 1970s. You can see the buy and hold, the brown line suffering, the Dow Theory going up. So there is outperformance, but more importantly, there is drawdown reduction. And this is very important because we traders, sometimes we get too focused with outperformance, and the best offense is good defense. So first of all, we should keep drawdowns in bay, because what is going to kill you, what is going to wipe you out of the market is the drawdown. This is going to finish you off. It's going to finish you psychologically and financially. So the first defense is to keep drawdowns at bay. Okay, this table summarizes the key figures of the Dow Theory versus buy and hold. You can see the compounded annual growth rate of the Dow Theory. It is 11.19% versus 10.67% for buy and hold. The standard deviation of annual returns, it is much lower for the Dow Theory than for the Dow Theory than for buy and hold. You can see 13 versus 16.4. Let's keep an eye on the losing years. Buy and hold on the right had 16 losing years, whereas the Dow Theory had only 10 losing years. There you can see the efficiency, not only the performance in terms of raw figures, but also how much is going to test your psychological fortitude. How much does it take for you to throw in the towel? Because I am a trader, so I know that even the best outperforming system can kill you in real life because one is not psychologically strong enough to stick to the system when it underperforms. So the number of losing years is a very important feature. So buy and hold had 16 losing years, and the Dow Theory had only 10 losing years. So it will test my patience much less. Okay, the profit factor. Profit factor is total win divided by total losses. So I computed the average annual percentage gain and also the average annual percentage loss for each year. So I did the summation of all the percentage won on winning years, and I also performed the summation of all the losses, all the percentage lost on losing years. So I divided the summation of winning and the summation of losing years. So we reach a profit factor of 13.32 versus a profit factor for buy and hold of 5.75. So this gives you a very good indication of the accuracy of the Dow theory in outperforming, but more importantly, in reducing drawdowns. Next, we go to the maximum drawdown on an annual basis. The maximum drawdown for the Dow theory was minus 17.9%. You see it here, versus a drawdown on an annual basis of minus 34.1% for buy and hold. So in other words, the maximum drawdown for the Dow theory was half the drawdown of buy and hold. So once again, what I said, the rule of thumb for the Dow theory is that we cut drawdowns by roughly half, give or take, but this is like a constant of physics. Okay, the second maximum drawdown for the Dow theory was minus 17.6%, and the second maximum drawdown for buy and hold on an annual basis was minus 32%. And here is an interesting ratio. I take the compounded annual growth rate of positive 11.19%, and I divide it by the maximum drawdown. So we get a ratio, and I put it positive. So I get a ratio of 0.6% for the Dow theory, and look at buy and hold, there is only a ratio of 0.3%. So in other words, we make 2 times more return per unit of risk incurred. So in other words, how good is the Dow theory versus buy and hold? I could say it's double good. It sounds strange. It's double good. It's twice as good as buy and hold. Why? Because per unit of risk incurred, I can make double money. So if you normalize per risk, you can make double money. So the Dow theory beats buy and hold on all counts: higher performance, smaller drawdowns, less time in drawdown, and a higher profit factor. Okay, now comes the big question. Can we do even better? Yes, we can do even better. Welcome to the Dow theory for the 21st century, what I affectionately call Shanep's Dow theory. Jack Shanep, our editor emeritus of our letter, began to research, and he came to accomplish what was almost impossible, to do an improved version of the Dow theory. And it really works, and it is much better, as you will see. Between you and I, Jack Shanep, for me, in my opinion, is really a genius, and his Dow theory is really something brilliant. What makes the Dow theory superior? Well, first of all, he uses 3 indexes instead of 2. You know that the classical Dow theory uses the Dow Transportation and the Dow Industrials. Jack added the S&P 500. Adding a 3rd index really results in much greater signal and much reduced noise. So the signal to noise ratio improves. And this is not an improved version. I will demonstrate that the addition of a 3rd index will improve the signal to noise ratio. So it is not just a statement. Secondly, Jack Shanep did away with the 1/3 to 2/3 retracements for a secondary reaction to exist. One of the tenets of the classical Dow theory is that following a primary swing, the secondary reaction must retrace between 1/3 to 2/3 of the previous advance or decline. Jack said this does not help. Everything has been tested, and I will show you the results. So no, we only need the 3% minimum movement. I said before that the only fixed parameter in the Dow theory is that we require a 3% minimum movement. If we don't get 3%, what we see on the charts is negligible, it's to be ignored. It doesn't matter, it's noise. Okay, the third improvement that Jack did over the classical Dow theory was shorter secondary reactions. What do I mean by that? The classical Dow theory requires at least 3 weeks, between 3 weeks and 3 months time to declare the existence of a secondary reaction. So at least 3 weeks. Jack Shanep realized that many important movements that result in important pivots to be broken out are created with a shorter time frame. So he shortened the concept of secondary reaction. Jack demands that the average drawdown, pullback, or rally, depends whether you are long or short, must average 8 trading days as the average of the 3 indexes. So we don't need 3 weeks anymore. And finally, we have 2 additional tools. The Dow Theory for the 21st century has 2 additional tools that help us fine-tune exits and entries, which is our capitulation indicator, which calls the end of bear markets, and the bull and bear definition. Okay, we will see them later in detail. So, when to buy? How do the Dow Theory for the 21st century rules? So, when to buy? Okay, I give you a real-life example, very recent one. Our most recent buy signal. You can see this was last year, 22. So we have a bear market. The market is going down. You can see the red downward arrow. The market is going down. Then the top chart is the S&P. The middle chart is the industrials. The bottom chart is the transportation. Okay. So we have a trend that is going down, as you can see on the charts. Then for the S&P on October 12, 22, we get the bottom here, and then there followed a rally, a bounce. This bounce met the extent requirement. It was at least 3% on the S&P here, and at least the Dow Industrials and the Dow Transportation, and the average time of this rally bounce was more than 8 trading days. So the concept of a secondary reaction under Shanep's Dow theory, the Dow theory for the 21st century, Shanep's Dow theory, was met. So I highlighted this secondary reaction against the bear market with the blue rectangles. You can see here, this is a secondary reaction. We have the trend going down, and then the trend goes up. But the secondary reaction is not a buy signal. Something more to get the setup for a buy signal. So following the secondary reaction highs here, there was a pullback, and this pullback was made by all indexes, but in particular by the S&P and one other index. We always demand the S&P and one other index confirmed. So the S&P and the other indexes went down more than 3%. Such a pullback sets up the stock indexes for a primary bull market signal. So once we have the setup for a primary or for a buy signal, then we wait for a breakup of the secondary reaction highs, which I highlighted with this blue horizontal line. You see here the blue horizontal line. This is the secondary reaction highs. So once we break up above these secondary reaction highs by the S&P and one other index, then we get a buy signal. In our case, the S&P 500 confirmed on November 10th, 2022, and we got our buy signal. Okay, so now when to sell? How do we get a sell signal? Okay, let's go also to one recent sell signal. From 2020 to 2022, the beginning in January, we had a strong bull market. So you can see here the blue upward line. There is a bull market. The S&P is making higher highs. Once again, top S&P, middle industrials, down chart, transportation. So, okay, we were in a buy mode. So as well, a bull market, we were with a buy signal, under a buy signal since I think it was April 2020. So the S&P 500 made a top on January 3rd, 2022, the industrials on January 4th, 2022, and the transportation much earlier on November 2nd on 22. Okay, so we had 21, sorry, the transportation made on 11/2, 21. Okay, so we got a pullback, secondary reaction. Once again, it lasted, the average of the three indexes lasted more than 8 days, and it was more than 3% on the S&P plus one other index. So the bounce qualified as a secondary reaction time-wise, and also as far as the extent is concerned. So this is a secondary reaction. Okay, the important thing is what happens after the secondary reaction to see whether we have an important pivot or not. Remember that I said that only important pivots matter. Okay, what happens after the secondary reaction lows here? Then we got a bounce. You see, it is highlighted by the violet rectangles. You see the violet rectangles. There was a bounce. All indexes bounced more than 3%, so there was confirmation, and at least 2 or more days, which is a requirement for the setup for a buy or sell signal. So we got the bounce, and time-wise, the time requirement was also met. So we got the setup for a sell signal. So this means that once the secondary reaction lows, which I highlighted with a red horizontal line, you see the red horizontal line highlights the vital pivot, which is the secondary reaction lows. So we have, it's very similar to the classical Dow theory. So we have the top, we have the pullback, then we have the rally. The rally fails to exceed the highest highs and then goes downward again. And once we get confirmation, a breakdown below the secondary reaction lows, we get the sell signal. In this case, the Dow Theory triggered the sell signal on February 22nd, 2022, 2 days before the onset of war. So it really had very good nose, the Dow Theory, in signaling that the trouble was brewing, that something was going on. Okay, so now you see roughly when to sell. There is another rule, but I don't have the time here to show it. The lows or the highs for a buy or sell signal of the last completed secondary reaction also serve as a sell or buy signal of last resort when we fail to get the typical setup for a buy-sell signal. But it will be too long, but I will show you an example toward the end of this presentation. Okay, let's continue. I told you that we have the Dow Theory improved, much improved, but we also have 2 additional tools to fine-tune our entries and exits. Okay, the first of such tools is capitulation, our capitulation indicator, and it's a very accurate indicator to call bear market bottoms. Our capitulation indicator measures the percentage of divergence between the Dow Industrials, the S&P, and the NYSE composite on their time-weighted moving average. So it is a kind of oscillator. Confirmation matters. Once again, we require confirmation. Capitulation has the uncanny ability to pinpoint the end of bear markets. It called the bottom of the last 10 bear markets. I must say that not all bear markets end up in capitulation. Some of them don't, but the great majority of bear markets end in capitulation. And curiously enough, the last 10 bear markets have been finished by capitulation. So capitulation signal the end of the last 10 bear markets. Important. The S&P 500 average return 12 months after capitulation is 29.2%, which is huge. You'll know that the average return for the stock market is more or less 8-9% a year. If we just take the index, So it's really, so there is something in our indicator. So it is not an oddity or just chance. No, there is something. So we buy a 50% position on capitulation day. I said we are trend followers, but some of you might be thinking, hey, watch out, you are catching a falling knife. So now you are doing mean reversion because you are buying when the market is falling. And it's true, we are buying a falling knife, but we know what we do. So we buy only half of the falling knife, not the full falling knife. We buy just a 50% position, and furthermore, we do it on capitulation, and capitulation has an excellent record at calling bear market bottoms. So it means that we are not so crazy. So sometimes we want to make money, so we are trend followers. But of course, we must be flexible to know when it's time to shift gears and to say, okay, now is the time maybe to be contrarian. Furthermore, Dow Theory's Ray said in his book that there is time when there is panic or semi-panic, when it's time to cover shorts and go modestly long. This is written in Ray's book, The Dow Theory. So there is a time that you have to have the courage to be a pig sometimes. So we buy a 55% position on capitulation year. And now the bad news. From its bad news, the current bear market has not seen capitulation yet. I repeat, some bear markets do not end in capitulation, but most do. So I would feel much more comfortable if we had seen capitulation, because then I get the courage to go all in, to buy on capitulation 50%, and to know that I have the wind on my backs, that there is a tailwind that will propel stocks much higher 1 year after. So the bad news, we didn't have capitulation yet. Okay, the second additionally tool in our arsenal, a bull and bear market definition. I'm sorry to disappoint you, but the plus minus 20% typical definition for bull and bear markets does not have enough forecasting power. I'm sorry, but it's close to meaningless. Our bull definition, it means plus 19% on both the Dow Industrials and the S&P. So we need a rally of 19% or more on both the industrials and the S&P. A bull definition resulted 90% of the time in advances to over plus 29%. So it's another signal that puts the wind on our backs. Okay, our bear definition. It means minus 16% on both the industrials and the S&P 500. A bear definition results in a further average loss for the S&P of minus 13%, with a total average decline of minus 34%. So this has forecasting power. In our newsletter to our subscribers, there is one of our letters where I tested a trading system based only on the bull and bear market definition. So I ignore capitulation, the Dow Theory, I ignore everything. So it was only based on the bull and bear market definition. And to my surprise, it was really a very decent trading system. So it cut drawdowns, it outperformed, so it worked. I'm not saying that you should trade based only on one tool, but of course it proves that the bull and bear market definition works. Okay, so this was our second tool in our arsenal. So let's put everything together. Let's see how the Dow Theory performs versus buy and hold, and also the classical Dow Theory. Well, here we have the same chart as before, but now I included the Dow Theory. We start with $10,000 in 1953, and we finish in December 2022, okay? So we see buy and hold, red, we made the 10.9 millions I showed you before. This is the red line with lots of drawdowns. Then we see blue, the classical Dow Theory, much better, much lower drawdown, and there is outperformance, $50.1 million. But now, please fasten your seatbelts, buckle up. The Dow Theory made 70.1 million in the same period. which is a huge outperformance. All this has been made on the Dow Jones Industrials Total Return. Many of you will be saying, yes, but this is a back test. In reality, well, I have to tell you, part of it has been back tested, but a big chunk of it has been traded in real life because we have our ladder, and this ladder has been running for many years, and these are the trades we have in our real portfolio. We buy and sell. It is true that, of course, not all trades have been done because in 1953 we were not with our ladder, but many of such trades have been done in real life. So, okay, let's move on. So we see great outperformance. And the table below shows you the key figures comparing the Dow Theory for the 21st century on the left, the classical Dow Theory, the middle, and buy and hold on the right. Our compounded annual growth rate for the Dow Theory was 13.69, so much higher than that of the classical Dow Theory, 11.19, and of course much higher than buy and hold. The standard deviation of annual returns was also much lower than that of buy and hold. We only had 10 losing years, the same as with the classical Dow Theory. So both Dow Theories only lost 10 years versus 16 years for the classical Dow Theory. I insist, psychologically, this is very important because the less time you are losing money, the less time you are in drawdown, the less time you are underperforming buy and hold, the more likely you are going to stick to your system because we underestimate our frailty, our weaknesses. We feel very macho, as Paul Tudor Jones said, don't play macho with the markets. So we should know that in real trading, the market is going to find our weakest point. So it is very important to keep drawdowns, the depth and the time in drawdown as contained as possible. Okay, let's continue. The maximum drawdown for let's go to the profit factor. Look, unbelievable. The profit factor has been calculated the same way as I did with the classical Dow Theory. I took the average made on winning years, the average lost in losing years. I did the summation of winning years, the summation of losing years, and I divided positive by negative. So look at our profit factor, 18 versus 13 for the Dow Theory and versus 5.7 for buy and hold. So it means that we are much more accurate. So profit factor gives you a measure of accurateness. So it means it's really very accurate in appraising the trend. Our maximum drawdown was only minus 15% in 2008. The classical Dow Theory, it was minus 17, quite okay, but buy and hold was minus 34. And look at my favorite ratio. I divided the compounded annual growth rate of the Dow Theory, 13.69, by the maximum drawdown, and I got 0.9% versus 0.6 for the classical Dow Theory versus 0.3 for buy and hold. So in other words, the Dow Theory made 3 times more return per unit of risk incurred than buy and hold. So in other words, once again, I said before that the Dow Theory is double good as buy and hold because we make 2 times more return. Then the Dow Theory for the 21st century is 3 times better than the classical Dow Theory because per unit of risk incurred, we make 3 times more. And furthermore, if you compare it to the classical Dow Theory, it is also better because the classical Dow Theory had a ratio of 0.6 and we have a ratio of 0.9. So we are much better than the classical Dow Theory. You should always keep an eye on profit factor because profit factor, looking only at drawdowns and growth rate, okay, it gives you an idea of trend following system, but the profit factor tells you how much money you lost to make $1. In other words, our profit factor of 18.6 means that we made $18.6 for each dollar lost, which is huge. And I guess there is no trend following system out there able to score such a high profit factor? Okay, let's move on. Okay, some of you maybe will be thinking, yeah, because there was a bull market, a secular bull market, there have been bear markets, but the bias, there has been a bullish bias in the stock market, more or less 8% bullish bias positive per year. So maybe, okay, you had tailwind, so well, maybe it's so good, the Dow Theory. Well, let's do one exercise. Let's short the Dow Theory. So when the Dow Theory signals a sell, we will short, and when the Dow Theory signals a buy, we'll cover. So I performed this test. As you can see, we have a start capital of 10,000. The start date, the first short, is February 5th, 1957. The end date is November 10th, 2022, the last cover, because it was the most recent buy. So went up with a final capital of $46,000. And more importantly, look at the profit factor here. Look at the profit factor. We almost made a profit factor of 2, which means that for each dollar lost, we made $2. So this is an excellent profit factor. Please remember that we are shorting against a secular bull market. So we are swimming against the tide. So if you are able to make almost 2% profit factor against such a huge secular bull market, then it means that the Dow Theory for the 21st century really has some good timing ability. Look at the maximum drawdown of minus 25%, which is excellent. You will say, wow, 25%, hey, watch out. Buy and hold had a maximum drawdown around 50%, and we are shorting. So we are going against the tide. So scoring a 25% drawdown by going short, I think it tells you a lot about the accuracy of the Dow Theory for the 21st century. Okay, here you have the equity curve, because maybe some of you might be thinking, well, maybe it was due to an excellent short, but most of trades were losers. No. Look, here you have the equity curve, starting in 1957 until now. So you will see, as with any trend following system, there are ups and downs, but you see that it goes nicely up all of the time. So even when we were suffering or were enjoying, depends on whether we are long or short. If we are short, we were suffering a huge bull market in the 19s, we were being successful in our shorts. So it means that we are really accurate when it comes to shorting. Okay, so you will ask me, okay, what's the current stock market situation? Well, this slide gives you the current stock market situation. On the left side of this slide, we have what I already explained, the setup and the last buy signal, the one of November 10, 2022. I explained it before, so here you have it. Yeah, you have the buy here. And what happened after this buy? Okay, then there was a secondary reaction. The yellow rectangles, you see the yellow rectangles here, here, and here. So it was more than 8 days as the average of the 3 indexes, and more than 3%. And this secondary reaction was successfully cancelled, successfully terminated by higher highs. You see, it goes down and then it goes up, and we made a higher high on the transportation here and on the S&P. So we need only two. We need the S&P plus one other index to confirm. So confirmation by the transports was enough to declare the end of the secondary reaction. And then we have highest high. And once again, there is a drawdown, there is a pullback. You see the brown rectangles on the right side of the chart. This is the current secondary reaction. There is a pullback. And until now, we did not get the bounce that would set up for a sell signal. And some of you will be asking, what happens if we don't get a setup for a sell signal? Then don't we have stop loss? Yes, we have. Under the Dow Theory for the 21st century, and also under the classical Dow Theory, The lows of the last completed secondary reaction, so the last completed secondary reaction, the previous one, not the current one, is the one shown in yellow, this one. The lows of the last completed secondary reaction is our stop loss in case we don't get a stop loss at a higher level. So in this case, we require all three indexes breaking downside the secondary reaction low. So in other words, here you have the red horizontal lines, which show the the lows of the last completed secondary reaction. So all indexes should break down below such lows. As of this right now, only the Dow Industrials broke down below such lows, and the S&P and the Dow Transportation have not broken down such levels yet. Maybe today, I don't know. Now I'm not checking the markets. We had a down day, but the last time I checked the markets, we were still far from a sell signal. We shall see. Okay. So now comes the question. Can we apply the Dow Theory to other markets? Now I mean the classical Dow Theory. I'm doing lots of research about expanding Shanip's Dow Theory, the Dow Theory for the 21st century, to other markets. Preliminary, I think it works well, but I want to be fully sure before I do this jump. So for the time being, what I know firsthand is that it works, the classical Dow Theory works when applied to other markets. So the answer is yes, it works. The Dow Theory works when applied to other markets. Dow theorist Hamilton wrote in 1922 that the law that governs the stock market applies to other markets as well. I have also a private blog, free, and I've been blogging for almost 11 years. So my blog reports the successful application of the Dow Theory to precious metals, their ETF miners, GDX and SEAL, crude oil, and bonds. And my trades were shown in real time. So it's not that I made up after now, no. In real time I was publishing. Furthermore, I was on Seeking Alpha. In Seeking Alpha, you cannot change what you publish. So it's there for all to see. So the Dow Theory did a better job at outperforming and cutting drawdowns than moving average and breakout systems. Okay, sources. Because I don't have the time here, because we could be talking hours and hours. But if you want to know how well the Dow Theory performed when applied to other markets, here I give you the links to blog posts or website, everything. Here you have the sources. First, the Dow Theory applied to gold and silver and to and their miners, GDX and SEAL, applied to crude oil. So if you download the slides after the presentation, you will have all the links. More sources, and then of course I also applied to bonds, to US bonds. Does the theory work when applied to US bonds? Yes, and it works extremely well. I would say even better than for stocks, or at least as good as with stocks. It works great. Here you have the links. I applied to I derived the signals by using TLT and EDV, and then I apply it to TLT, to EDV. There is also a post on comparing the Dow Theory performance with a moving average. You can guess what's the answer. So more sources. And now, once again, the proof of our timing ability is going short. You know that until last year, bonds were in a very strong bull market. So let's apply the Dow Theory signals to the ETF, the long duration bond, EDV. We have start capital of 10,000. Our first trade is on January 21st, 2009, our first short. And our end date is July 22nd, 2022, our last cover, buy to cover. Well, went up with a final capital of $22.9 thousand. But the important thing, look here, the profit factor. We are going short against a secular bull market. I repeat, so it was a strong bull market until last year. So by going short against a strong secular bull market, we scored 5.85% profit factor. Once again, this is based on annual percentage gain or loss. I take the annual percentage gain or loss, total gains divided per total losses. Okay? Okay, 66% of trades are profitable, which is a similar measure to that of the Dow Theory. By the way, this tells you, this attests to the efficacy of the Dow Theory. You know that most breakout systems, they have a 30-40% win ratio. The Dow Theory normally has a win to lose ratio, percentage profitable trades over 50%, normally 60%. So it's a testament to the accuracy of the Dow Theory. Okay, we had a compound annual growth rate of 6%, which is unbelievable because we are swimming against the tide. If we adjust for the time invested, we would have scored 9.35%, and our maximum drawdown was minus 22%, which is excellent. We are shorting against a secular bull market. So it is a much smaller drawdown than made by buy and hold on the long side. So it's really great. So once again, here you have the equity curve of shorting bonds EDV with the Dow 30, because many would think, well, maybe it was just one winning trade. It was not. 66% of trades were winners. But nevertheless, I will show you the equity curve, and you will see that I'm not making things up. So there is a persisting bullish equity curve. We were short, but so there is a tendency to really to squeeze any profit, any likely profit from the market, even when going short, which is a testament to the accuracy of the Dow Theory as a timing system. Okay, so now let's go all in now. Let's go all in now. What happens if we go long and short EDV with a Dow Theory? So when we get a cover, then we buy, we cover and buy, and we get a sell, we sell and sell short. So we are all the time invested. Please mind that this is just for testing purposes, because I would not short EDV, the ETF. To short, I would short futures or an inverse ETF. But this is just to simplify things. You get the idea, which is the important thing. So we start once again, a start capital of 100,000. The start date is before. It's November 7th, 2008, first long. And the end date is, when I finish the test, is March 7th, 2023, an open short. Well, here you have it. The annual growth rate, the compounded annual growth rate is 12.15% for the Dow 30 versus minus 0.74, so negative for buy and hold. I know that with dividends, buy and hold would have made some 3-4%. I know this is just for illustrative purposes only, but you get the idea. You get the idea. To short, use futures or an inverse ETF. But you get the idea. So it's really trouncing, the Dow Theory is really trouncing, beating buy and hold. And we have a much lower standard deviation of annual returns, which is also lower volatility. We only have 4 losing years, only 4 losing years for the Dow Theory versus 8 losing years for buy and hold. And our profit factor going long and short is 6.65%. versus a profit factor of 1.34 for buy and hold. You should say, wait, I don't understand, because you said we have a negative compounded annual growth rate, but you note a positive profit factor for buy and hold. This is because we take annual returns, and on our returns you get this oddity. So it is not a typo. But you get the idea once again. So we are trouncing buy and hold. Our maximum drawdown when long and short was minus 26.5%, and our maximum drawdown for buy and hold was minus 57%. So we are really beating buy and hold on all counts. Here you have the equity curve. Of course, there are ups and downs because you have to pay a price to outperform. So this is the price you pay when you do trend following. So it's not a straight line. If it were a straight line, everybody would do trend following and then it would self-destruct. But of course, the issue is that we outperform by a long shot and we cut drawdowns. So before we finish, some final clarifications. Some alleged Dow theorists say that the Dow transportation is no longer important because of the modern economy, blah, blah, blah. Well, the Dow transportation is still necessary for the Dow theory. Example, in 2007, the transports saved our bacon by seriously diverging from the Dow industrials, thus negating a buy signal when a new bear market was about to start. So it is important. It is important. So any claim to an improved Dow theory with more modern indexes must be backed by a long track record. So not just anecdotal evidence based on a couple of charts. And divergence and lack of confirmation are not the same. Many people say, yeah, divergence, lack of confirmation. It is not the same. They are frequently misunderstood. This chart shows the difference between divergence, the left chart, and lack of confirmation, the right chart. Divergence has a different meaning than lack of confirmation. Lack of confirmation just merely says that the current trend is being questioned, is dubious, but divergence tends to precede an explosive move. Not necessarily the end of the trend, but explosive move in either direction. Okay. So here are your additional resources. If you download the slides, Jack Shanep, my alter ego, my mentor, and editor emeritus of our letter, gave an excellent presentation. So you can get also additional insights with his presentation. There was also an interview with him. So I strongly encourage you to really listen to Jack Shanep. I learned everything from him. So it's really, for me, it's one of the best Dow theorists ever. You can also take a look at our website. There is lots of good free stuff. And also to my blog. Here you have all the resources. And of course, if anyone is willing to subscribe to our services, here you have the data, the link, the dowtheory.com, sign up now. And it's $2,400 annual. And I think you really get lots of value for your money. We also monitor US bonds, precious metals. Of course, we monitor the stock market. We have a couple of real money portfolios. We eat our own cooking. And you will have access to all our past reports. So it goes back to the 1960s. So you will see that our performance is not an oddity, it's really, really documented. And of course, if you have any questions, you can contact us at editor@thedowtheory.com. Please mind the Dow Theory. So if you don't put the Dow Theory, then you go to another website, editor@thedowtheory.com. Okay, I think that was all. If you have any questions, or Shane, up to you.
I posted a couple questions in that private chat there that have come in so far, but to our audience, if there's any additional questions, go ahead and send them in now. We'll hang out for a couple more minutes here, and if nothing else comes in, we'll wrap things up. Okay,
I will answer your question. Let me see, because I will scroll up. Okay, good question. What books would you recommend? Okay, the must-have is Jack Shanep's book, The Dow Theory for the 21st Century. This is a must-have book. The second one I would have is Robert Raya book, The Dow Theory. As simple as that. Robert Raya, it was written in the 1930s. It's also an excellent book. Jack Shanep drew a lot from Robert Raya. And while not strictly Dow Theory, but Gary Antonacci, who's been always with you by the CMTA Association, has also a great book on momentum, but such good momentum with a Dow Theory filter works wonders. So I would also get acquainted with Gary Antonacci's work. Okay, question second, do you trade your Dow Theory on just 3 indexes, or do you use it as an uptrend indicator to trade the stocks? Good question. Or do you use the Dow Theory directly on stocks? Okay, I use it 2 ways. And I have 2 portfolios for our subscribers. So the first portfolio is just the Dow Theory on just the indexes. So very simple. So I take SPY, the spiders, I take the DAY, so the DAs. So I take the three indexes and I apply on such indexes. But I also have what I call relative strength plus Dow Theory, a portfolio that targets significant outperformance, and then I use the Dow Theory as a trend filter to trade high relative strength stocks. So it can be used both ways. You can use it as is, as the Dow Theory, a trend filter. Buy signal, you buy one index, the S&P, the industrials, or maybe a combination of them, or you can use it to really, if you want to go for it, as I try to go, then my second portfolio, I use the Dow Theory as a trend filter, and then I select high relative strength ETFs. Or one could do it with high relative strength stocks. So the possibilities are open. There are lots of possibilities, and you can use it as a trend following filter, and then do your own thing. Okay, another question, good question. Is there a minimum time frame that you should be trading with the Dow Theory? Well, I hope I understand the question properly. I use daily bars. So as far as time frame is concerned, the Dow Theory is based on daily bars. We only use closing prices. We ignore the highs, lows. We only use closing prices on daily bars. And there is a minimum time frame, but the minimum time frame is to define a secondary reaction, because the pivot point of the Dow Theory is the concept of secondary reaction, because you take your buy and sell signals based on the break up or breakdown of secondary reactions. So you need to define properly and objectively the concept of secondary reaction. And there comes what I explained before, the concept, for instance, in the Dow Theory for the 21st century, we require 8 trading days as the average of the 3 indexes, and also a minimum extent requirement, 3% movement from top down or bottom up for a secondary reaction to exist. If we don't fulfill both the time and the extent requirement, then the pullback or the bounce does not qualify as a secondary reaction. So yes, there is a minimum time frame in the sense that our key concept, the secondary reaction, because everything revolves around this concept, must have at least 8 trading days and an extent of at least 3% on a confirmed basis, always confirmation. Okay, for question, can we add other macros like BDI along with the Dow Jones Transportation and Dow Jones Industrials for the longer term trend? I think yes, definitely yes, because as I said before, you can use the Dow Theory as is. Okay, you take the buy and sell signals, you apply it on the SPY or whatever, and you trade it. You can do it a little bit more sophisticated, as I also do in one of my real life portfolios. I take high relative strength stocks, ETFs, sorry. But of course, the possibilities are open up, because the Dow Theory is an excellent trend filter. And you should maybe keep this in mind. And this is the vital insight. The Dow Theory can be used as a trading system. But the Dow Theory is also a great trend following filter to know when it's convenient to be in and when it's better to be out of the market. And then you can use any measure, any indicator, anything. And I'm sure the Dow Theory will increase your bottom line. Okay, I see you are in the market good eye. You have a good eye. I see you're in the market 26% of the time. How long are you on average in a trade each time? How long? So trade, it depends on the market tone, but the average trade lasts 1 year, give or take. So for instance, in 2020, we went long stocks on April 4th. I think we went 100% long on April 4th, good timing. And we were stopped out on February 22nd, 2022. So this trade lasted more than 2 years, but there are trades that last less than 2 years. But normally the average trade, because of course, if you go to my blog, my private blog, I gave the link before, I performed many studies comparing the Dow Theory, buy and hold. There is a wealth of information on my blog, on my private blog, and the average trade duration is 1 year. Sometimes it can last 6 months when there is a whipsaw. It happens, and sometimes it can be 2 years, 3 years. But the average trade takes more or less 1 year. Another question. Let me see, because there are many. So yes, we are in the market. It depends on the market. I want to finish this question. 26% of the time out of the market. It depends on the market. There are markets where we are less time in the market. It depends. For instance, the stock market has had such a bullish bias in the last 30 years that we have been in the market, I would say, almost 90% of the time. But it depends on each specific market. It depends on the market. Okay. Muchas gracias, Señor Blay. Thank you very much, Mr. Blay. Thanks to you. Thanks to you all for bearing with my Spanish accent. I really try to do my best, but it really betrays me, my Spanish accent. Okay, that's all the questions that have come so far. Okay, thanks very much you for following me, for bearing with my Spanish accent, and I hope next time I will do it better. Thanks to you.
You were incredible. Incredible. No problem with the accent. I think everyone heard you loud and clear, and I think based on the comments from our audience, this presentation was well received, Manuel. So on behalf of the CMT Association, I just want to extend our sincere gratitude to you for today's presentation.
Thank you very much for having me here, and really, and it is a handicap, my accent, so I do thank you. I do thank you.
Not at all. Not at all. To those interested in the audience, today's presentation has been recorded, and we will be making it available in our video archives before the end of today. So if you do have any additional questions that we could not get to today, or that you think of while watching this archive or any of our archives, please feel free to email them to any member of the CMT Association staff, and we'll gladly pass them along on your behalf.
Yeah, with pleasure.
Yeah, of course. Manuel has also been gracious enough to share his email, which you can see on your screen right now. So if you have any specific questions for him, go ahead and send them directly over. You can also find him over on Twitter. For the CMT Association, my name is Shane Squarek. I thank each of you for spending the hour here with us, and hope you enjoy the remainder of your day. So long, everybody.
Okay, thanks a lot. Have a nice day.
Take care.